I'm going to cover the tax treatment of insurance premiums, of death benefits, of proceeds, and dividends, and all that good stuff. So dividends and a whole life policy are not taxable because they're essentially unused premiums. So what happens is a company, you pay your premiums, and when you have a policy with a insurance company that pays dividends on your whole life policies, you're paying a little extra every month. And what the company does is they take that money and they invest it. And at the end of the year, they say, based on their earnings and how many claims they paid out, they say, hey, did we make a profit? And if they do, they give you some of that profit back in the form of a dividend. So it's like earning like extra interest on the money that you put into the policy. That dividend is not taxed, or it's not taxed at all because it's technically unused premiums, because the company's just saying, well, the policy was actually cheaper than the amount that you spent this year, so we're going to give you some of this money back. So dividends are not taxable. Next is cash accumulation. So cash accumulation, it grows tax deferred. Okay, so cash, like a whole life policy, the cash value in a whole life policy will grow tax deferred. So there's no tax paid on it. And the only time cash accumulation is taxed is if the policy is surrendered and the amount of money in the cash value is more than what the client paid in. So for an example, say there's $100,000 in cash value after 30 years, and the client only paid in like $70,000 in premiums, but between interest and dividends and everything, the cash value was more than what they actually paid in. Say they surrendered the whole thing for the cash value. They paid in $70,000. The cash value was $100,000. So there's a $30,000 difference. So they would only pay tax on the $30,000 difference, which means they would only pay tax on the excess amount minus what they put in. All right. So you have $100,000 cash value. $70,000 is what they paid in total into the policy. The $30,000 difference is what would be taxable. Next, policy loans. Loans are not taxed. So policy loans are not taxed at all. So if you take a loan on the cash value of a whole life policy, it is not taxed. However, the loan does accumulate interest that people would have to obviously pay back over time in some way, or they just don't pay it back. And it'll just come out of the death benefit. So next is surrenders. So surrenders are when someone surrenders a policy for its cash value. So like I said before with cash accumulation, if you surrender a policy and the cash value is more than what you actually paid into the policy in premiums, then you have to pay tax on the difference. So same example as before. If you have a $100,000 cash value, you surrender that policy and you only paid $70,000 in premiums, the $30,000 difference is taxable. You get the $70,000 back tax-free. Now, there are also accelerated death benefits. So if someone's terminally ill, they can receive the death benefit ahead of time, usually between 50 and 100% of the death benefit, depending on the carrier. So example, say I had cancer, heaven forbid it never happens, knock on wood, and I was deemed terminally ill. The doctor said I had less than a year to live. I could get the money ahead of time, the death benefit of my policy ahead of time. So the company says, hey, you're going to die anyway. We're going to give you the money in advance just to help you out. And if I do that, I don't pay tax on that money. The only exception sometimes is for certain chronic illnesses like dementia or some other things, where if someone can elect, some policies have like critical illness riders or chronic illness riders, where they can elect to receive some of the money from the death benefit if they have one of those illnesses. They are tax-free up to a certain amount. Now, the limitations vary by year and state and stuff like that, but some states may not even have the limitations. I know in Florida there is. The course doesn't go over exactly what the limitations are, but it is up to a limit for some of those chronic illnesses. So example, say I had for the terminal illness one, say I had a $100,000 life insurance policy and I was deemed terminally ill. The doctor said I had less than a year to live. I could get that whole $100,000 death benefit advanced to me before I pass away, and I don't have to pay tax on the money. Next, payments to beneficiaries. So this is the last one I'm going to cover here. Payment to beneficiaries, like death benefits. Now, a lump sum death benefit is typically not paid to the beneficiary at all. Okay, so a lump sum death benefit, say I had a $100,000 policy, I die, my family gets $100,000 or my beneficiary does, they don't have to pay income tax on that at all. Okay, the only time there is an exception with that is if, say, like I sold the policy to someone else before I passed away. Sometimes that's a taxable event where like someone buys the policy for a profit, and then they may consider that a taxable event. But typically speaking, like just straight death benefits to beneficiaries are not taxable. And then settlement options. So it's one settlement option if you die is like a lump sum benefit, and then another one is interest. So say like the policy receives interest payments from the money that the insurance carry. So say I leave $100,000 to my family, I die, the beneficiary gets $100,000. They decide for a settlement option to say, you know, we're not going to take a lump sum. We're just going to let you keep the money and then receive some interest on that every month. The interest that's accumulated on you holding the money in your account. And then they would have to pay tax on the interest, okay? But then once they pull out that whole amount, they don't have to pay tax on like the principal, right? The main $100,000 amount. So if there is a settlement option with interest, then the interest is taxable because that's additional profit that happened after the actual death of the insured. So I hope that helps you understand how life insurance premiums and benefits and cash values and stuff like that are taxed. If you have any questions, please drop it in the comments. Sorry if I went too fast, just go through, watch this again. Drop any questions in the comments and watch the next video coming up here because you're really going to want to watch this for another great tip on how to pass your pre-licensing exam on the first try.